Like, I think microcaps has been strong because for two reasons. One, the quality has kind of improved over time. So you've had better businesses listing, you've had better businesses sort of coming to the fore. You've had some household names do very well over a period of time. So people are starting to say, okay, what's done well, why has it done well, and should we be looking down the cap spectrum from small to micro. I think that's one driver. I think the other driver is the fact that large companies have started to underperform, and so money's going to flow down into looking for smalls and microcap ideas, and you've had a bit of a general re-rating of some of those ideas. So a combination of better quality businesses doing really well, a lot of IPO activity in that space, bringing investor interest and attention down to that microcap spectrum, and then money flow sort of following performance down from large to mid, and then ultimately small, and then micro, basically. So a couple of factors really driving that. I hope so. I mean, I think it's. Investing in microcap and small cap is about avoiding the losers as much as it's about making great investments, about finding the winners. So a lot of what we do and how we think about investing there is saying, okay, well, there's a lot of names out there, a lot of opportunity, a lot of risk. How do we minimise that risk and therefore shrink the universe down to a bunch of things that meet the criteria for being better quality investment ideas? In toto, it's had a good run as a sector, but I think you have to be selective and cautious about what you're doing, and we're seeing some signs of overvaluation in micros and smalls, some signs of stocks that don't have a lot of fundamentals backing them up, that have performed very, very well, and thus have very high ratings on very low earnings or cash flow basis, and that typically is a time when you start getting concerned as a fundamental investor that things could unwind or share prices could underperform. So I think, look, I'd say broadly, we see opportunities, but I wouldn't say it's going to continue to perform as well as a sector as it has over the last couple of years, because it's performed very well, certainly versus large in the last 18 months or 2 years or so. And that you have to be careful about what you're doing, how you're doing it, and just making sure you stick to fundamentals. And if the fundamentals stack up, it'll be a good investment, but they need to stack up for you. As you well know, financials are typically reliant on other intermediaries to raise their source of capital in order to continue to roll the earnings out. So it's quite easy to grow as a financier if you promise attractive interest rates or you're offering something to someone, you can grow earnings very quickly. The problem is you're relying on other parties to finance your business. Typically, it's not just internally generated cash flow. You're relying on banks or the high yield bond market or something else to raise capital to recycle into investor loans or whatever it happens to be that you're writing financial business for. I guess we see some risk that we've had very low, very easy credit terms for a long period of time. People have got very complacent about credit risk, and if there's any change in that credit risk or risk metrics tighten up for intermediaries or banks, or bond markets dry up, for example, i.e. the sources of credit dry up for those businesses, you can have a massive contraction in those earnings and a sort of crisis on cash flows. And so those are really the reasons we see that there's a lot of risk around financial companies. So everything from things like Credit Corp to the sort of party lenders like cash converters, Silver Chef. There's a whole bunch of names in there that meet the criteria where they don't generate enough internal cash flow to support their earnings. They're reliant on third parties to provide their cash flow or their the debt which they then lend out. And we've just seen historically when those things are dried up, they all get very, very badly sold off, and the earnings get hit very, very aggressively. Or they come to markets and try and raise capital from shareholders at the worst possible time. And so as an investor, you get diluted down very heavily. And so our process is all about minimising risk, and therefore we see that as a pretty material risk, and it's a very discrete risk. It comes along, it's hard, it hits you quickly. There's no way of really getting out of the position, and so we just tend to avoid it basically.